listen, guys, what we want to do today is, there has been a lot of talk about sort of crisis. You read TechCrunch, you read anything, but how to thrive, okay? Because there's a different way to sort of to approach the moment that we are now living, okay? And therefore, I mean, we want to have sort of to exchange views. And by the way, we will also take questions. So please prepare your questions, okay? Because that's something that I always like doing. So guys, first, panelists, I mean, first to start with, I mean, is there now a crisis? Okay, have you, in your businesses, in your investments, have you really felt already a crisis, or maybe it's not? Be controversial.
No, I can start. So, of course, there is no doubt that in the public markets, there is a big decline in valuations. And of course, late-stage funds, growth funds, are going to be hurt with that. We, in our case, we invest at the seed stage. So companies like, really small companies, like raising 2-3 millions. So to be honest, in our segment, we haven't seen so far a big impact of the crisis. Of course, everyone is really concerned because in the end, this is a chain, right? What we invest has to be invested later on by another growth investor, whatever. So everyone is trying to anticipate what the late stage guys are going to do. But so far, here in Spain, I don't know if it's good or bad, but in the past years, we haven't seen such a massive growth or crazy valuation. So there hasn't been a big excess so far. So I think we are, in our case, so to give you the truth, we keep on investing. So I think we have 3 or 4 term sheets right now, flying over there.
Excellent. So he's open for business. Open for business. So Stephanie, from France, what have you?
Well, I think we're back to normality. So we have 2 years of things that were unbelievable to see. Founders raising crazy money under PowerPoint. I mean, crazy round of 200 million with cash out for founders. I mean, we're just back to a certain normality that will last, because when we look at the fundamentals of Europe, we have a war in Europe, I mean, for sure. So it means that people who look at other geography, maybe the States, maybe South America with biggest interest, it's sure that we have no more exit markets when we look at the IPO today or some of the valuation that dropped by 50%. But on the other hand, this is an opportunity for all of us. This is an opportunity to be on our business fundamentals. This is an opportunity for us as investors not to do crazy things. I mean, I'm often reflecting on some investors putting money like this. Okay, this is not casino gambling what we're doing. And you, as entrepreneur, you have also in the responsibility in the way you use the money that people like us are giving to you. And so this is why I do think that we have normality. It's back to normals, back to when you do a business, you do it at some point to have a scalable business, to hire people, not to fire them 6 months after, to be able to have some profitability at scale. And as for us, we've always been investing in extraordinary founders, looking at that company that are scalable. So it doesn't change anything, and we're super active in investments.
Yeah, well, I tend to agree with both of you, but with a different point of view. What I see in my network with the VCs that I talk and the companies that I talk is that obviously there is less cash and there's going to be less liquidity that there was in the past on the VC. I mean, which means that for VCs it's going to be harder to raise money from LPs, no? And that means that they are going to be more cautious, as they said, on which company they invest on. And that means that probably in the coming months, in 6 months, in 1 year, they will not be in a hurry to invest in companies that are doing well, no? Which is a big difference from the past. If you found a founder that was doing well in the past, he will raise money like this, no? And what I think that we're going to see now is companies that are doing well, and it's not so easy to raise money, and especially in the short term, and especially in some concrete verticals, no? That has an impact in two things. One is, I mean, if there is less cash, that has an impact on valuations, no? And that has an impact on where you should focus. So far, most of the VCs like companies that grew very fast. And the main focus was on growth, because there was liquidity, you need to grow, you have to win the market, we will invest again in you. That message changed. And that's a huge change internally. I mean, as an entrepreneur, I know how difficult it is to communicate the company or main KPI, where North Star metric, where we are focused. And from one month to the other, we entrepreneurs, we have to share to our employees that they need to focus on revenues, no? And this may be a very big impact on the company. Maybe the people that you have is not the right people. Maybe the things that are on the OKRs are not the right things and you have to change them. And also, I also think that we will start seeing some down rounds, like companies that will raise money at a lower valuation than what they raised in the past, no? And that also is a huge impact for the team and from the founders, the stock options and everything. But I mean, it's something that we can deal with, no? And as a last point, as she said, like, I also think that it's a good time to do things that you cannot do in other moments, no? I mean, many companies that want to grow very hard do things that help to grow, but penalize retention, penalize monetization, penalize the user experience. Now you are in the perfect moment to change that. And nobody is going to ask you why you change things that hurt growth, no? And which I think is a great opportunity.
Yeah, I mean, I think that actually, just to add a different point of view, I mean, probably in 2021, people were thinking that valuation was a perfect match to value, okay? Now there has been sort of a bifurcation between valuation and value, and now valuation is coming down to actually meet value, but a bit lower than before, okay? And before, everything was about increasing valuation. Now, I think it's more about sort of value creation, no? And on value, what's the first thing that a company is valued for? Revenue, okay? So in this, well, apart from IP, apart from a number of other assets, but on that regard, how should entrepreneurs right now here, by the way, who's an entrepreneur here? Excellent, many entrepreneurs. So how do we grow revenue now? Or how should we refocus the way in which we think about revenue in this environment? Any practical thoughts, any ideas?
Maybe sorry, the mic is not working, so I'm using this one. Few tips that we addressing to our funders. As first, we invest at seed stage. We have 40 investment done so far. We have already what I call 2 centers company that are above 100 million euros of revenues in 3-4 years. So we always favor business that are profitable at scale, which means that we will look at the revenue generation, the distribution levels, the way you can have virality when you market your company if you consumer tech. Second, often what we see is that funders, especially at seed stage, do not pay attention to the unique economics of their business and do not pay attention to the way the cash is generated. So you can have a wonderful business model, you can sell to customers, but at the end of the day, if you don't take back the cash, you need cash. So cash is king. So make sure that when you're an entrepreneur, you have the correct cash collection, you have the correct invoicing, and you're able to be financed by your customers. So again, I mean, private equity, venture, we're here to accelerate. We are not here to pay for the bills of the consumer on behalf of your model that is not scalable at all. So this is why, I mean, I guess that what is happening today is good. Focus on the business economics.
Yeah, as you said, Oriol, revenue is the most important metric, but of course, not all revenue is not created equally, right? So you could be selling $1 for 50 cents, and that be I'm pretty sure your revenue would skyrocket, but you would be creating no value, right? So I believe that we are at a point in the cycle in which fundamentals matter, right? And if you ask me, and this is going to disappoint you, I have no special recipes for now. I strongly believe that good advice works in boom times or in crisis times. You should be always doing the same, like building a business that grows at a high pace, and for me that means at least 100% year over year, and pay attention, of course, that you're creating value. How do you check that if your unit economics are healthy or are on the way of becoming healthy? They don't work always from day one, right? But there has to be a path in which you can believe that you're building value ultimately. Tactical stuff. Cash is king, of course. So, for instance, if you are selling monthly subscriptions, why don't you start selling yearly subscriptions? That's going to help you to collect more cash more quickly, and you can reinvest that cash, right? But focus on another advice, or, well, one key message for me. So I have no doubt, and I might be wrong, that there's going to be money for good companies. I have no doubt about it, right? And good companies mean what I said before, companies that are growing at high rates, but that are building value, right? And never build companies thinking about what investors want. Always focus on the customer, right? And the money will follow. So because what investors think is a moving target, you know? And right now we think A, but in 15 months, that is when you're going to fundraise, the goal has moved, right? You have to always build whatever you feel is good for the customer, and the money, I'm pretty sure the money will follow.
Yeah, I agree with Samuel. I think that now is a moment where customers are especially relevant, more than, and the good thing is that I feel that now investors or entrepreneurs are very aligned with that, no? At some points, depending on the investor, it could be different in the past, not for everybody, but for some people do. And now everybody is focused on product market fit, customer-oriented, retention, and that's super relevant, and it's going to make your life much easier. And regarding revenues, I mean, every company is different, and my advice here is, guys, try as many things as possible, fail as fast as possible, be honest with yourself, communicate well to your team so that they know that fail is part of the experience and you know that you're going to fail. But if you fix things fast, that's going to work on the long term. And revenue is relevant, but I also believe that cost cutting and cost reduction is reasonable now. I will be very surprised if a startup, I mean, different thing is if you've raised money in the last 6 months, then you're in a completely different scenario. But if you didn't, I think that every startup is obliged to cut costs, basically because there is a lot of uncertainty. We don't know where we're going to be in 6 months, in 1 year, in a year and a half. And the sooner you react, the more cash you will have on the bank, and the easier it's going to find a way to create those revenues that you need now, no? And try new things and be creative.
Just a couple of also practical things that a few of the startups are doing. One is, if you are more in B2B, going back to what Stephanie was saying, is look at the sales cycle that you have across all your customer base. Okay, look at the payment cycle that you have across all your customer base. Maybe there are a few customer segments that have too long a sales cycle, that the payment cycle is too long, and therefore you can refocus on those that are sort of more cash now, I mean, closing sooner, so that your sales teams, okay, maybe maybe can sort of maybe dismiss or maybe not focus so much on big enterprise customers that usually require payment terms that are very long, that usually require sales cycles that are very long, and right now that probably sort of would not be a focus. No, at the same time, also look at your ABC of customers, okay? And there are customers right now in industries that are suffering, that you know that they are suffering. Just put them on a warning, okay? Put them on a warning, even if you are on a B2C startup, okay? There may be areas, okay, that customers that you're having, okay, that potentially are sort of not as affluent as others. Put them on a warning, just watch them, just put alarms about when they don't pay as often, as much, as frequently. Going back to efficiency, you know, because I think that revenue is important, and you guys, it's important that you know efficiency. I think that efficiency maybe rather than just cost cutting. So how do you get more efficient?
Yeah, I agree. It's not only cost cutting; it's many things that you have to do, but
It's a more positive term, no?
No.
Do you like more efficiency or more cost cutting? What do you like more? Efficiency, no? Come on.
No, I agree. It's not only cost cutting, but cost cutting is healthy in any organization at some point.
Yeah.
In a startup, it is.
So give us some examples of things that you've done in past companies that were sort of interesting to look at this point, that could be applied in terms of efficiency.
Well, one thing that is crucial and every startup faces at some point is to have properly work with OKRs. For OKRs is basically you define a few objectives that you want to achieve in a certain period of time, usually in a quarter, and then it divides in a month, and then it divides in weeks. So everybody in the company knows what they have to do during the next 3 months, and everybody's aligned, and then at the end you achieve what you want. No? That's a super hard process to implement. That requires a lot of time and in many cases help from external people. But if you implement that properly, that changes everything. No? And to make sure that everybody knows what they want to do and the whole company is working on the same direction to achieve what they want with the proper communication, and that's one of the most efficient things that you can do on a company for sure, no doubt. Yeah.
And particularly in times of uncertainty, where people may not know what to do.
Yeah, that helps a lot. At the same time, if you do that, start with, do it for the next week, and then for 15 days, and then for 1 month, don't start with the 3 months because you will be crazy. But yeah, that works very well. Make sure communication. Efficiency starts with the communication always in any organization. That spend a lot of time as a founder communicating with your team and making sure that they know what is happening. Because if these moments are new for everyone, you talk with most of the people in the market, and 1 month ago, they will not consider that we will be where we are today, no? With the news that the big VCs are sharing with their participative companies and everything. If that's tough for you as a founder, imagine for the employees that you have on your company, no? That's even harder. So you really need to spend time and communicate properly so that they understand where we are and what is happening, no?
Excellent. Any new ideas about efficiency?
If you're an early stage startup and you have, first of all, focus on having a business that works, right? So in the beginning, there are many companies trying to do many things at the same time. So perhaps it's now the time to focus all your energy or your money or your effort into making one thing work really well, rather than, like spreading yourself like too thin. That for me is key, because I see many companies or in order to achieve your long-term vision, but okay, it's fine, so we love that, but in order to get there, you have to make the small thing with which you begin to work really well, right? So, as we were saying before, so we've been in a bull market for the last 10, 12 years, whatever, with tons of cash available. Everyone has committed excesses. We investors, entrepreneurs, everyone. So cut the crazy stuff, right? Everything that you are not sure if it's adding value right now to in the next 15 months, it's time to cut it. And if you have that feeling, do it fast. And if you believe you have to lay off people, whatever, do it fast. Don't do it slowly, dragging your feet. Doing for 10 people today and 10 people 1 month afterwards. It's better, to swallow the poison pill quickly and to move forward.
Yeah, so few tips. First of all, think about your runway. And yes, it could be about cost cutting and efficiency, but often, I always say to our founders, how could you get some 6 extra months? And if you're still alive in 6 months, maybe you will have the opportunity to be very well alive in 2 or 3 years. So don't quit. So it's also one advice. When I see founders who don't quit, even when it's complex, ultimately they make it. And we've been a few positions in our portfolio where we've been here for the founders, and at the end of the day, they've done very well. Hire soon a chief financial officer or finance lady or guy, because many companies think it's better to have developers rather than a finance guy. But I can tell you that it's a way of being more efficient in your equity, be more efficient in the way you monitor your cost, your unique economics. So having soon a finance person is key. Last but not least, when we look at startups, scale-ups, most of the costs are people. So make sure your recruitment are efficient. I always see founders, I mean, we put 2 million, 3 million. Yes, I'm going to hire 50 people. Okay. How do you make sure when you're hiring, you have the correct onboarding, value, culture? You have also not spend money with several headhunters. So the sooner you can get your in-house talent acquisition team, that makes a lot of sense also. But it's about being efficient in the recruitment, because when you hire, you have to fire fast. Hire fast, fire fast if it's not working. And make sure you keep people, retain people, because hiring is always complex. So this is why this is a fantastic opportunity. The real company with the real business model, with the real culture, will be able to attract the best talents. And we're ending up this silly competition war of talents.
Excellent. Actually, a follow-up question is, you guys have gone in your companies through, yes, through some right sizing of the team, okay? What happens with the team with the people that are left in the company? How can we still sort of make them believe that this is a fantastic project, that we're going to win, that we need to stick together? Any sort of ideas, any tricks that you can tell to our audience?
Yeah, a few of them. My experience is that when you have layoffs, like several relevant layoffs, like you get rid of 30% of the company, 40%, that's a lot. That has a huge impact on the culture, on the atmosphere of the company, because at the end, people is friend of other people, and suddenly you are half the size. If you do that cascading, and that is properly explained, the people that stayed, in my experience, mostly they understand that it's not because you are going to bankrupt. It's because you are adapting the company to survive, which is very relevant, because you have a vision, you have an objective, you want to create value, and you also have to look after the money of your investors. And to do these things that nobody likes to do is the proper way of doing it, no? So communication helps a lot, being super transparent, being super honest, that people really appreciate that. And also something that worked very well for me in the past is to go back to the mission and vision, no? There is some people that stays in your company and join your company because they like your vision. You want to build something and to solve a problem for society. And there is some people that if that stays and you're still working towards that, they will stay because they want to fix that problem, no? And that works very, very well.
Some people have even mentioned raising salaries of the people that stay. Have you thought about it, or even doing a more ESOP kind of sort of ESOPs to the people that are staying? Have you said?
No, I have experience with that ESOP, and is that you fire half of the company. The ones that stay, you want to give them something because you want them to know that you appreciate them and you want them to be committed, and you give them more stock options. The problem is that probably on the next round, the valuation of the company is going to be lower than on the last round. So in my case, what happened is that they perceived that I was cheating them, like I was giving them something that at the end will not have any value, because the value that I'm giving them, the stock options, will be, the next round will be lower. So yeah, I made a mistake there, and it's relevant to really think on not making mistakes, no? On understand what is your communication and why you are doing things, and be open to feedback, because I'm sure that some people noticed that that was not the right thing to do, and I did in any case because I didn't get that feedback. No? Sorry.
I fully agree with what Enrique said. I'm not sure what you should do, but I'm pretty sure what you shouldn't do, or the worst thing you can do, is to lose the credibility of the team. So don't sugarcoat things. Like, they're adults, right? Explain them the things as they are. We are laying off people because this, and this. And remember, we are here because we believe in this, and we also believe that the best way to get there is by doing this. And the people staying here, you're going to have opportunities here, whatever, right? But don't lose the credibility of the team, like telling them, you know, fairy tales about whatever. They are adults, professionals. I'm pretty sure most of them in this tech economy, they're going to find new jobs super quickly, even for the ones that are being laid off. So please don't do that. So be open and transparent, and they're gonna understand it.
Yeah, I will give an advice for business angel. Who is investing here? Okay, not so much. But for entrepreneurs who have business angels and investors backing them, often we see the non-sophisticated investor panicking. I mean, looking at that, say, wow, it's crazy. I mean, we have no more exit possibility. I mean, the valuation, now we should stop investing. I'm saying the contrary. This is the best moment to invest, but with rationality, with paying attention with the really good
Investors
funders.
are here. Investors are here.
Funders. And same for the investors. You back company before. This is also the moment to be behind them. If they have cash issues, it's the moment to really make the bridge happen. Because it's very easy to see, okay, I'm investing only in company when it's good moments, company, atmosphere is good. No, the real investors are the investors that are backing you in the bad moments. So there's never been so much opportunity on the market that now. And we're very pleased, as for us, to be looking at the really, really enduring entrepreneurs.
We will be talking about fundraising in a second. But are there any burning questions? Anyone has a question about what has been said so far? No? Yes, please.
Thanks a lot for the speech. What is the common mistake that you see in the startups that fail? Is it a matter of cash conversion cycle? Is it a matter of HR? Is it a matter of margins?
Be very quick. Founders quit. So I think that the main reason why startups fail, at some point, the founder decide that it's over. It's purely. So you can read many books around that. So the most important decision we take as investors, especially in seed stage, because growth stage, you can replace the founders. You have CEO. But between seed to Series A, it's complex. And even if you look at the very impressive company, the founders remain till the IPO. Impressive one, the big one. So founders never quit, even when it's hard. You have to make it. You have to. You have this responsibility over your investors, over your team, over yourself, over to your family. And I see too many founders, especially the newbie founders, saying, I've not been able to raise in 6 months. I'm stopping. It's hard. Never quit.
In my experience, so the most obvious one is lack of product market fit, which is a fancy way of saying no demand for your product, or it's not possible to build a business around it. And related to that, but not exactly that, conflict between founders. It happens a lot, actually.
Yeah, that's super common. And the other one is don't react fast. I mean, it's like in a startup, everything happens super fast. And 1 month is a lot of time. And if you see a problem, you have to fix it as soon as possible. And doesn't matter how to do it or what is in the middle. And sometimes you need alignment more than agreement to make things happen very, very fast. And I think that's a very, very common mistake because in many cases it's very hard to do.
Also because cash tends to run out in the companies that go bad, okay? That's an important thing. Okay, hey, let's talk a bit about fundraising. I know that there's a couple of questions over there, but just, okay, how the narrative has changed or should change, or what can we tell to the entrepreneurs here about their next fundraising, okay? Because as you were rightly pointing out, Stephanie, there are investors and it's a good time to invest, but how should they be talking about with funds right now, as opposed to maybe talking in 2021, 2020? Anyone?
I'm going to be very provocative. I see many funders thinking that investors knows. They don't know. I see many investors that just follow. When you're funders, it's terrible. You have so many people from the investing side who wants to follow, not taking conviction, decision on I'm going to invest. So when you're looking for funds, you should look for people who have the decision power to lead a deal. And I'm always saying to my funders, okay, if this guy is needing, especially when we're already in the companies, if this fund needs to have a lead to decide to invest, I don't want him. I don't purely want them because they're not going to be able to sustain the company. So I see many investors who lack investing condition. They don't know, they have no conviction. The only conviction they have is that when a company is trendy, and you never know why a company is trendy, yes, they want to be in. And then the funders receive 15 term sheets. And then he has the choice. And I always also say to funders, when you come to us, if there's a competitive process, it's not for us. It's like a wedding. Are you going to date many women to know the woman you want to finally marry? No. You marry the one that you love. Same with us. If you don't love me, don't come to be invested by us.
That's a good point. Any ideas?
What was the question, sorry?
So about fundraising.
Fundraising,
How is the narrative changing?
Yeah, I got it.
I mean, Stephanie, your speech out the wedding was impressive.
Yeah,
okay, I have to tell you.
When you say that to funders, I mean, always, yeah,
okay.
So don't put me in competition. You're not doing the same with your wife. Now,
you put a lot of responsibility on yourself.
But
you need to be in love with a lot of funders at the same time.
What we're asking to funders, and we haven't changed your investment thesis for 5 years, we want exceptional funders who are able to build long-term business, but with rational. So we love capital efficiency models. And I say, as a matter of proof, we have in our portfolio already 2 companies above 100 million of valuations. Not valuation, sorry, revenues. And with a few, I mean, that have made it from 0 to 10, 20, 30 million, not raising like hell. So cash efficiency when you go to see an investor like us, profitability of your model, and rationality. Rationality, because at the end of the day, you're going to exit your company based on EBITDA. I mean, it's terrible, but at the end of the day, you sell your company or you IPO based on EBITDA.
Very tactical here. So my advice is, if you have money now and you're doing good, go out and fundraise now. So don't wait. Don't try to optimize the valuation. But the best time to raise money is when you don't need it, right? Because you're going to be in a different mindset, right? And for the investors, is the same. So even though you could, wait a little bit and try to optimize, don't do it. So if some reasonable investor approaches you and offers you something which is also reasonable, perhaps not optimal, take it, right? Because if that's going to give you runway for the 10 more months, 12 more months, take it. In general terms, I'm not a big fan of venture debt, but right now you have also like cash in the bank. I think it's a good moment to raise some debt and extend your runway, because right now the worst thing is not that we are in a crisis. The worst thing is that there is a lot of uncertainty. People don't know, right? So when everyone is clear that we're in crisis mode or we are not, decisions are going to be made more clearly. But what you want to avoid at all costs is uncertainty. So get the money that you need to to navigate that. Of course, if you can get that from your customers, even better. But if not, raise now that you don't need it.
100%. I fully agree. Raise money when you have money in the bank. That helps so much. And then the other one is I will talk, if you are on seed stage, I will talk a lot about product market fit. And I will dedicate all the effort of the company for product market fit. Because it takes a lot of time, it's super difficult to happen, it's super difficult to measure. But at the end, if you have product market fit, then revenues come, retention come, and the company is going to look great. So maybe it's the time not to grow so fast, to do things, work hard, very hard, but make sure that you invest your money in a wise way, in the correct path, to have and demonstrate product market fit. That will be my advice.
Going back to the question before, what's the most common cause of failure? One of them is premature scaling. Like, hiring a lot of people before having product market fit, that makes you slow, burn a lot of money. Actually, you lose your advantage as a startup, right?
Yep,
so
I agree.
Yeah, and actually what I was going to say is that one of the key measures whether you have product market fit or not is whether your customers love you and stay with you, okay? So then, think about those customers that love you. How can you also capture a bit more value from them? Can you offer them more product? More products? Can you cross-sell? I think that now there's you need to think that growth is obviously important, okay? And usually for a VC is the most important, but retention, product market fit, the feeling that customers will be with you over the long term, okay, is also super important. And that's where I think that there's a bit of a balance there. And also something that I was discussing with one of the founders is, can you get those margins a bit up? Meaning, over, maybe it's not necessary now to launch this new front-end product, but if you can get, particularly in B2B startups, 5-10 percentage points, because either you go onto new customers or you just become more efficient in yourself, that will put you in a much better position than companies that have tiny margins. No?
And don't do anything that, sometimes I hear things like, pay later your providers or try to squeeze them. Don't do that, right? Because that's going to create kind of a snowball effect in the economy, which is going to harm everyone, right? So honor your commitments and,
Excellent. Any questions?
Hi, thank you. Regarding a little bit before, you were talking, can you hear me? Okay, yes. Now? Yes? Perfect. Thank you. Regarding before, you were talking about, in times of crisis and cutting costs and everything, right? With all the pandemic happening, there's a lot of remote work accessible right now. So I've seen a lot of companies outsourcing their tech core products overseas. What do you think about that?
As for us, we never invest when the tech is outsourced. Because we do think that the value of a tech company, it's the tech. And we did that one or two where we didn't have tech in-house. And believe me, putting tech in-house is super hard. So no, focus on the tech is important, but there's something on managing your tech. As a company, we have a tech team because we build our platform to be efficient in the way we work. So we are investors with a tech team. And as for me, the most difficult thing is to really assess the efficiency of the tech team. How do you make sure that your tech team is efficient? And how do you make sure that your tech team is really delivering against the deadlines? So as a founder, I think it's super hard.
Yeah, sorry, you agree?
Go.
No, I have a different point of view. For some verticals, for some startups, if you are a pure tech company, you need your tech team inside. That's super clear. It's extremely hard to do it outside and then change the culture of the company so that it's inside and hire the right people, and it will take time and it will be like a nightmare. But then there are other companies that tech is relevant. They are a startup, but it's not everything around tech, no? That they give other services, that they have other things. And in that case, to outsource that, especially when you are seed, tends to be cheaper and tends to make things go fast, no? And if you go fast, you save money. So that could work, but as soon as you can, as soon as you have a round, I would recommend to start building the team inside. Yeah.
So we have time for a last question before. Anyone? Any burning question? Excellent. So we have the last question. Now, a few people here have money in the bank. Actually, may have significant amount of money. Why? Because they may have raised money over the last few months, over the last 12 months or something. With those guys, there's now a new way of growth, which maybe is inorganic, maybe is going out and maybe acquiring companies, or maybe acquiring and so forth. Is that something that you've seen? Is that something that you would recommend people to explore in these moments of time? How do you see that one?
I think we've mentioned it before. For the ones that have money right now on time, it's going to be a time of opportunities. You can hire more people cheaper. You can buy, as you said, companies. You can do many things. So I think it's a wonderful time for the ones that have, done their homework before. It's going to be wonderful.
Yeah, I fully agree on that. This is a good moment for build-up. However, be conscious that for the company who wants to do build-up, you need to have some cash. Often you need to raise some money to make it happen, or you need to raise some debt. And with this market, I mean, the growth funds and the LBO funds may be at risk, and the cost of debt is going to be higher than before. So the golden era for build-ups maybe was a few months ago. Now, it depends really on your economics. Yes, you can do very interesting hacky hire again. But never forget that if your business plan is built on buying another company, it needs to be contributive and not implying a dilution at the end of the day for your investors or for you as a founders. So, and it's a lot related with the cost of debt, which for sure will be increasing. And everybody today is looking at the venture loan, the venture debt. So it means that there will be much more, intensity or competition to get venture debt, and same for the LBF funds. So, but as far as we love the build-ups when properly executed and when relative for the company.
Excellent.
Yeah.
Excellent, perfect. So, guys, a quick round of applause. I think it's been fantastic. And it's a time to thrive, okay? Don't get the crisis be too much in your heads.